This is the Daily Market Rundown live from the Tradelo trading floor. It's July the 15th. Some highlights from today's show. Nvidia can now resume chip exports to China. Long bond yields are rising across the G10, and US CPI data is now in focus. Good day traders, and welcome to another day of trading. Looking across the board, it's been quite a quiet session, of course, for Europe. We do know in some of the overnight hours, the Chinese, Asian hours, we did see a little bit of movement in the particularly the US markets, and that was on the back of the news about Nvidia. So with that in mind, let's get across and talk about Nvidia, as that is, of course, our first topic for today. So what's come out? Well, it's this idea that Nvidia can resume its H20 sales to the Chinese companies. Now, why this matters ultimately? Well, if you go back, I think sort of March, April, when the trade wars were kicking off and we had the retaliatory comments, one of the ideas was that we want to avoid sending our best chips from the United States to China for one, security reasons, but two, also to slow up the rate at which they are adopting AI and, of course, racing against US AI companies. That was the logic given back to us then. And I think it's very, very important to stress that logic, because I think the market's getting ahead of itself a little bit on this idea that there's going to be a free flow of chips from the US to China, because there is this little thing called licensing that's going to be required, and ultimately the market's sort of almost front running this idea that it's going to be unlimited, sort of sales to the likes of China. So I think keep a very, very close eye on that, and in particular in the video over the course of today, because I suspect we're going to get a little bit of a sort of a tapering of expectations, perhaps, on exactly what this means. Now, the White House has not actually confirmed this, but the general thinking is that there was some talks between Huang and, of course, President Trump. Obviously, the idea was Nvidia was going to lose around $15 billion per year in sales revenue, and as a result, they're now going to allow some licenses to be issued, and of course, some sales of the H20 chip. So, what does that mean? What are the numbers? Well, we just don't know, but if we go back and we look at March, April, the very reason they restricted the sales of these H20s was to limit the speed at which AI gets developed in China. Now, that definitely has not changed. They are not about to allow the free flow of the best chip stack across to China, because they will, of course, risk what happens with the likes of Meta and Google and then the likes of Microsoft. So just keep that in mind. Taper your expectations. Don't get caught too much in this hype. And if we go and have a look at the hype chart, I mean, there is Nvidia. Now, two things to point out. We are at record highs. We are going to open 5% higher, so we're probably going to open in record high territory. But very, very importantly, look what Nvidia did yesterday. Okay, so when the market was rallying yesterday, in general, if we look across the board, Tesla's up 1% this week, Amazon up yesterday, Alphabet, Meta, all of them up. There were only two of the Mag 7 that were down. There was Apple and Nvidia. Okay, so the fact that Nvidia was down yesterday is perhaps pointing just to a little bit of an exhaustion. We can see that Nvidia, the biggest company in the world, is effectively up 93% since April. It's almost doubled its stock price off of the back of no new fundamental information. Okay. Now, yes, there's been earnings revisions, and I appreciate we are moving into earnings seasons, and I appreciate AI is the future, but we're talking about $1 trillion company doubling its valuation. Yeah. Okay. So just be cautious. This is not a time to chase the upside. This is not a time to be sort of investing your inheritance into Nvidia's stock price. Don't be surprised to see a little bit of a correction coming in. Again, whether that happens today or perhaps over the next couple of weeks, I think it's going to happen at a time when we get a general market correction, okay, which is incoming. We'll talk a little bit about the timing of that, but I do expect Nvidia is on borrowed time. I do think it's the market that you need to start looking to accumulate shorts, perhaps later on in the week once we clear out the OPEX. Okay, it's just the market's looking a little bit tired, but likewise, I think this news is probably going to catapult us to a record high, but I'm not sure we're going to get much more upside. And I think that'll be the clue today. I think a market whereby we open up at record highs, but perhaps see the market only close up 1 or 2% on the day. I think that's going to be a very important signaling as to what comes next for the stock price of Nvidia. Okay. Now, with that in mind, I think there's something very interesting going on. It's something we've been been talking about for a while now. It's long bonds. Okay, long bonds. Think 30-year bonds. Now, I know a lot of you are yawning and going, oh, what's this guy fucking talking about, long bonds? Who cares about long bonds? Well, the reality is long bonds matter at some point. Okay, they don't matter necessarily now. What we do know is that it started off with the likes of the US. We started seeing US 30-year bond yields trade to 510. We know that's a critical area. We know we backed off of there, but we know we're now starting to push back up towards that 510. Okay, it then filtered over into Japan. We know Japan's long bond is also getting slaughtered. It's at sort of historical highs. We know then also just a couple of days ago, we saw the UK 30-year bond yields spike a lot higher on all their budgetary concerns. And now, over recent days, we're seeing the exact same thing in French 30-year bonds as well as German 30-year bonds. In other words, there is a trend that is now very much with us that investors no longer want to hold duration. And that should be massively concerning because ultimately, long duration is something that a lot of pension funds use across the world. Okay, we also know that a lot of treasury whatever you want to call them, treasury officials in every country are looking to do the same thing, which is they're all starting to, avoiding issuing long debt and instead sort of going up the curve, sort of rather issuing more 10-year or more 2-year. Okay, we saw Scott Bessent doing this quite effectively, and this is problematic. Okay, if you're going to be financing yourself every year, you are going to create a lot of volatility in the rate space, but it's not necessarily something that matters today, tomorrow, this week, this month, this year. It is something that will matter at some point. Okay, the fact that now countries cannot issue 30-year bonds because ultimately they're scared yields are going to spike, that is problematic. And it's telling you that the plumbing in the financial system is somewhat disturbed. Okay, I think that's the way to look at this. You do not want to see this sort of sensitivity in the back end because it tells you investors are just simply not willing to hold duration at these yields. Okay, now typically if you trade bonds, when investors don't want to hold a bond, what typically happens is the market's going to need to reprice itself to a point where investors are willing to hold those bonds. Okay, that's how this works. It's a case of at what price point are people willing to hold duration. Okay, right now, very clearly the signal from markets is they're not willing to hold duration at these levels. Now, if we take the 30-year, for example, will they want to hold it at 510? I don't know. Will they want to hold it at 550? I don't know. Okay, the point is we're going to find out. That's the key. Yields are going higher, whether you like it or not, and they're going to go higher till the point that we actually see money start to chase and of course, buy that yield again. Now, what matters is we are going to see inflation over the next 6 months. We do, of course, have the CPI print today, and that's obviously the key focus for the markets, the key risk event. But let me paint a little bit of context. The expectations, okay, the expectations is inflation from the tariffs that were put in place from Liberation Day, the 10% baseline tariff. We are going to start seeing that filter down now to the consumer, okay? What we don't know, what nobody knows, is the pace and degree of inflation. Okay, you've got the likes of Trueflation that says there's no inflation. You've got survey inflation expectations that say there's lots of inflation. You've got the swaps curve saying there's lots of inflation. And you got some economists saying there's no inflation. You got Trump saying there's no inflation. You got the Fed saying there is some potential risk of inflation. No one knows. I think that's the key takeaway. Okay. Now, what that means is that there is a number of different scenarios that are hedged. And for us as traders, we have to understand what are the tradable scenarios. Okay, now, contextually, what's key to understand with regards to inflation, it's not just about today's print. It's about ultimately what the market thinks the inflation cycle is going to look like in the next 6 months. Because there is an expectation that we are going to see inflation start to reach the consumer this month, as in today's print, as well as July, as well as August inflation, as well as September. In other words, we're going to start seeing hotter inflation prints over the next 6 months, which means should we get a small miss today in inflation? Well, the reality is that the market is going to expect more inflation in the next couple of months. So they'll shrug off a small miss. What do we mean by a small miss? Well, if the core is expected at 0.3, that's the median, well, a 0.2 isn't necessarily a miss. It's just the timing of when those tariffs hit the market is not well understood. No one really understands the timing of it. Everyone agrees that there will be higher inflation, but no one actually knows when that is going to hit the ultimate consumer. Okay? The same goes for saying if we got a 0.4 print today, well, again, it's largely within line of expectations. Okay, so where I'm going with this is you have to be very careful trading the CPI today, looking for 0.1 beat, 0.1 miss as meaning anything in terms of the big picture. The big pictures we just do not know, okay? Now, what is tradable? And we'll get to this when we get to the chart, but I think just a few things to note from this ultimately is that we know the Fed is a little bit cautious. Okay, the Fed just wants to understand. They kind of want to get 3 months into the future and really just start to understand what is the pass-through effect of this inflation before they can resume cutting rates. Okay, now it's not to say they are going to resume cutting rates. We know that JP Morgan's Diamond came out and said it's a 50-50 chance whether or not ultimately they hike again. So this is the CEO of the biggest bank in the world, and he's saying, well, we can't completely rule out rate hikes in the future. So I think it's very, very important to keep an open mind as to what are the implications of these tariffs on inflation. We just don't know, okay? We do know Walmart, which is, again, someone that knows because they obviously have got real-time data. They are warning of price increases, which means they are putting prices up. Okay, so that's important to point out. And then, of course, there are anecdotal reports that suggest tariff-related price hikes finally did start to flow through in June. Okay, and that's why economists think we're going to get a little bit of a high inflation print today. But ultimately, this US economist at Santander is saying they expect the bulk of the impact to only come in July and August. Okay, and this is why today is a bit of a weird one in a sense that I think point one, either way, you kind of have to shrug it off. You kind of have to just look at it as, okay, it is what it is. But there are some outliers, and we'll talk about those now. Now, in terms of the expectations, you can go and read that for yourself. I think the key ones to focus on are, of course, the month-over-month headline. That's there, 0.3 expected, as well as the core month-over-month. That's also a 0.3. In terms of the range of expectations, for both of them, it's 0.1 to 0.4. Okay, so what I would say, generally speaking, in terms of how I'm going to approach this, a 0.2 or a 0.4 is largely in line with expectations. I'm not too interested in trading that. We do know, of course, services inflation has weakened over the last couple of months. We've actually seen inflation miss to the downside for the last 3 months. But again, the market's been shrugging off weak inflation prints. Why? Well, because we know those tariff inflation is coming down the line. Okay, so a 0.1 either way, I'm not too interested, but should we get a 0.5? Okay, let's discuss that scenario, because a 0.5 ultimately reflects a higher pass-through rate of inflation to the consumer. Okay, and that is going to be concerning. Why? Well, because we know that pass-through effect was as a result of the 10% baseline inflation. And we also know that President Trump is now imposing higher than expected or higher than Liberation Day tariffs on all the major consumers. Okay, we know EU, for example, he's threatening 30%. That's much higher than the 20% that he told us originally in April. Okay, we know that, of course, Japan, South Korea, they are getting as well also higher than expected inflation. So, tariffs. So very, very important just to stress, a 0.5 at this point will catch the market a little bit off guard. It will be a little bit concerning, and in particular, remember what I said about those long bonds, okay? Long bonds in particular are going to be the one that are going to suffer on this. Okay, you are going to see a steepening of the curve because, like I said, there's very few central banks right now that are wanting to hike rates. They're all sort of very dovish, wanting to cut if they can. So right now you are going to see a continuation of selling, particularly the long end of the curve. Okay. What about a 0.1 in terms of softness? Well, look, a 0.1 again is going to be music to risk markets. Here's why. Well, because you're going to have President Trump on the line telling Mr. Late that he needs to speed up things and cut because there's no inflation. Okay, so a 0.1 is going to be very positive for stock markets, particularly this time as we do move into the earnings season. So what you want to take away from all of this is, don't forget, contextually, we are in OPEX week. Okay, OPEX week means markets are going to be somewhat muted. They are going to be very stable. They're going to be very tight until we, of course, clear the OPEX. Okay, we'll talk a little bit about that structure in a moment. But there's the chart for you. You can see the core month over month. You can see that trend is very firmly to the downside. You can see this sort of 0.1 to 0.3 has been very much within the range of what we've seen over the last couple of months. A couple of negative prints, or not negative prints, but a couple of sort of down prints on previous months, a couple of up prints. But we are now about to see some higher prints around that 0.3. And then, of course, like I said, should we start to see maybe a 0.5? All right, a 0.5 at this point in the cycle is going to perhaps start to point to the US consumer being the one that's ultimately paying the price for higher tariffs. Okay, and that will scare the markets. Why? Because if the consumer is ultimately paying the price of all of this, it's not the likes of China and EU that are paying for the tariffs. It's the US consumer that's ultimately paying a tax to the US government. Okay, and what does that mean? Well, if consumers ultimately have got less money to to spend as a result of these tariffs, guess what that means for growth implications? They're going to have to be revised lower. Okay, so keep an eye on that. I think a 0.5 will shock the market a little bit. It will obviously get economists to revise this idea of what is that pass-through effect, and we just don't know what it is right now. Okay, in terms of the gamma profile, I think this ultimately is a good way to look at it for today, because what we can see via the option space, via the 0DT, is a very interesting picture. If you look at the implied hedging going into this, in other words, how is the market positioned for this? Well, roughly speaking, the market expects about a 40-point move in the S&P. Okay, so roughly speaking, 40 points is kind of what the market's hedged against. But what we can see to the upside and to the downside is effectively a pinning effect, where roughly speaking, if we look at the close of 62.92 yesterday, around 60 points, call it, to the upside, you can see quite a lot of positive gamma, and ultimately that's going to pin the market up there. That's going to prevent the market from ultimately rallying. And if you look to the downside, there's very little in the way that's ultimately going to, sort of cause the market to sell off from a hedging perspective. Okay, only if we dropped all the way down to 6,200, which is almost a 100-point move, are you actually going to see some hedge flowing to the downside. In other words, you're going to see some forced selling in the market as a result of dealers having to hedge very aggressively in the futures. Okay, the point is that we're kind of in no man's land here. Now, of course, this 0DT can definitely change, and it will change once we get the data. But what this points to is we are very much capped to the upside. I don't suspect we're going to scale above that 63.50, even if we saw a 0.1 on the core CPI. Yes, it will be very positive for the stock market, but what the market will do on a miss in inflation is it's going to go, thank you very much, we like the idea of rallying 50 points, we're going to do those 50 points, and then that's going to be it. Okay, so that is the play of the day. It's look for a 50-point rally up to 63.50 in the SPX. That is the play of the day. Then obviously sell the 63.50 because as a result you are going to be able to trade both sides of the market up there. Okay, to the downside, be very, very careful. Like I said, the profile can shift quite a bit. Should we get a 0.5? Okay, by all means 0.5. Maybe the market scares a little bit, maybe, but like I said, it's OPEX week. It's not really the week in which we're ultimately going to get too much downside. We need this gamma to clear ultimately before we can actually get that downside move. Okay, so that is the scenarios which we're going today. And then in terms of the bonds, there you see it. That is the 30-year yield. You can see we're trading around that 5%. But more importantly, there's the 10-year yield. Like I showed you last week, we have broken out of that trend channel now. We, of course, are sitting at these higher yields. What is interesting about this chart, okay, is this little purple line. What is the purple line? It's the 200 moving average. Now, why does this matter? Well, if we look at pretty much the month since October, so you go all the way back to September, October, November, look how flat that line's been, around 420. Okay, so 10-year yields around 420. Where are we averaging now? 437. Okay, like I said, path of least resistance for yields is higher. The reality is that investors want higher yields, and that's why yields are going to go higher, because no one wants to buy the bonds at these yields, because it's not justifying the risk they have to take in the current economic circumstances. Okay, so expect high yields, but like I said, it's not exactly going to go spike. Fine, you get a 0.5 on the print today on the core, all bets are off. We're probably going to trade that 460 pretty quickly, but then again, a number of things are going to happen at the same time. Okay, and then finally the S&P. Very interesting chart, looks almost identical to Nvidia. Two things I want to point out. Okay, the price action is bullish. There's nothing bearish about this price action. There's no reason to be short today, but contextually, okay, big picture, zoom out a little bit. Look where we've come from. We've gone from 4,900 to 6,400. If I show it to you on the NASDAQ, we are up, listen carefully, 41% in 90 days. 41%. This is the NASDAQ cash chart. Okay, now it's not to say that a 41% mark cannot continue. Of course it can, but there are no real fundamentals driving this. Doesn't matter whether you want to argue earnings revisions are higher. The reality is there are a number of risks that are calling into question this rally, and so what typically should happen now, we should neutralize it with time either. In other words, the market spends a bit of time over here, or we get some form of a correction. Okay, my bet, By the end of this week, you can start to sell these indices again. You will get some form of a correction. Okay, but we need to clear this week, of course, because it is the OPEX for both VIX and, of course, the indices. Okay, but coming back to the S&P for today, yes, we are broken after record highs. Yes, we are in a sideways consolidation. Yes, I expect the market to extend to the upside. But again, everything is going to depend on that inflation data. But like I said, today is not the day necessary to start selling this unless, of course, we get some really significant upbeat prints in the CPI data. Okay, with that in mind, like I said, it all hinges on, of course, CPI. Any sort of misses, 0.1 miss on the CPI, 0.2 miss. Risk markets are going to love that. They're going to love it up to 6250, like I said, into the SPX. So that is the play. But also, any kind of beats, the bonds are sensitive. The long bonds are sensitive. Okay, make no mistake right now. Trust me on this one. Rule of thumb, when yields cannot sustain or when yields ultimately are moving in an upward trending direction, they are going to go as high as required to ultimately entice investors to come in and start buying those yields. Okay, right now, yields are pushing higher. At some point, that'll matter. Perhaps not today. That's a rundown for today. Then if there are any other questions, do post them in the Discord channel. Otherwise, good luck out there. Manage the risk. Go make some money.